Okay,
Me too.
whenever you're ready.
All right, great. I am definitely ready. Well, hi, everybody. Thanks very much for having me. Now, while we're here, I'm here to talk about income taxes and real estate agents and other business kind of planning for real estate agents, and I appreciate Linda inviting me. And let me turn this on.
Can I introduce you
Sure.
real quickly? So I just want to let everybody know that Chris and I have known one another for about 15 years.
At least, yeah.
So when I was an agent in the Princeton marketplace, Chris was my tax accountant. And he actually was working with another realtor in my firm that I was partnered with at the time. And he would make that drive into Princeton once a year to sit with Roger and I to discuss our taxes and to help us get ready and be prepared. And he was my go-to for years and years and years. It was only when I got married and my father-in-law is a tax accountant that I'm like, sorry, Chris. But he's still my go-to as it relates to real estate questions and for my clients who have questions that may impact their ability to sell or buy. And you know those questions that you get asked that we really can't claim to know what's current. He's always my go-to. Knowledgeable, very good at what he does without being too nudgy or pushy. So I've always appreciated that as well. So anyway, I just wanted to share with you guys the background. Coincidentally, lives in the area.
Yeah, I live in the Chapel Hill section, down behind Whole Foods there. And my office is across the street on Oak Hill Road, so I could walk to work, which is nice. Chris Whalen, CPA, as we can see, for over 25 years. I've been the owner and managing partner of my own CPA firm and business advisory firm. And we partner with real estate brokers and agents. I do a lot of work. I personally don't invest in any stocks. I only invest in rental real estate. So it's one of my favorite things to do. We do a lot of investment property strategy work for individuals and retirement plans. We do tax benefit analysis for clients of different things and strategies, especially the higher net worth you get, the more planning you need to do. And commercial transaction analysis. I'm usually very heavily involved in looking over commercial sales statements, the leases of property. A lot of these documents are accounting documents. So anytime you have an attorney drawing up a closing document, a CPA should look at it because it's not a legal document. It's really a tax and finance document. I find a lot of mistakes. Not that attorneys don't have the best intentions. So again, we work with individuals and businesses, estates and trusts, and the nonprofits as well. And my motto is, if we aren't working for you, then you aren't working at your best. You're close. You're almost there. 99.9% there. But to get over the top, you need me. You need to hire my firm. So here we're talking about everyone's mind is the Trump transition. And in my whole career, this is the biggest change, biggest potential difference, but some of the greatest opportunities for people like you that's coming up. So it's a very, very, very good time for all businesses. Just a little aside, usually in November, December, I do a lot of startup kind of meetings and merger meetings, and people want to invest money in things. So those meetings were 3 times higher than last year since the election, just because people are more positive.
Well, people want to know, I think, how this is going to affect us. And that's, I think what's the interesting part of it is how is this stuff going to affect us.
And
So we'll kind of just breeze over some of this initial information.
Right.
Really in-depth. He has a lot of in-depth information that he's put together on it.
You'll see a lot here, so it's probably more than even you bargained for. So listen, usually my audiences think of Trump either one of these ways. So, but we're not here to talk about politics because that doesn't matter. Here we're talking about something more important, tax and how it impacts you. So, but objectively, to be honest, that from a middle class perspective, everything I've analyzed and been interviewed about is that where we were going in the country was a very terrible path, and at least this gives us some hope for business, middle class, and to really sort of to get us on a better path towards rebuilding the middle class, which has been pretty decimated for a long time. And it's a great opportunity for real estate agents. So what I wanted to do here is just to go back a few years to see where we are and how this could have impacted your business. So Obama instituted the American Taxpayer Relief Act, which really raised taxes, and it put the highest income tax bracket to 39.6%. and need for married people over 450, single people over 400, and that impacted a lot of our potential clients in the area. And that's a lot. And the same thing with capital gains. Capital gains were raised from 15% to 20%. Another thing that impacted the amount of money people had to buy homes, whether it be residence or investments. So a lot of you probably didn't realize that around 2012 that this had happened. My mortgage brokers did, and it really impacted the amount of house people could buy. It was really significant as we do a lot of this work, and it was dramatic just within a year's time. So the same thing with the Affordable Care Act, which is similar, and this is where we are still right now, until Trump makes changes. So we have an additional Medicare tax that people were paying, and I had people come in that had poor planning that were paying this, and they owed money for the first time in their taxes. So, and that's for married people earning over $250,000. I don't think a married couple making that much money are high wage earners, to be honest with you. And so that was a real problem. The same thing with net investment income tax. So certain people could have another 4.6% even right now, and a lot of people aren't planning for that in their taxes. So itemized deduction, very important thing for you guys, right? Because we sell a house, and part of the benefit of not renting is, you get to take these as a greater deduction. And so what could happen with these? So the rules can change from this and impact you very much. One of the reasons why people buy a house is to get the deduction, the itemized deductions. But there's some people in Congress that want to limit the mortgages and real estate tax deduction, even eliminate it. So that's something to really watch out for. That's not something Trump's talked about, but some Republicans in Congress are thinking about it. So he's going to be changing income tax brackets, but it also could be affecting itemized deductions, which dramatically impact the reason why people buy homes. It's very important to stay on top of that, which if you get on my mailing list, you will be, because I update these things all the time, especially for real estate agents. He's thinking of increasing the standard deduction to $15,000 for a single, $30,000 for a couple, which is much higher, but then again, it might come at the cost of some of the itemized deductions being eliminated, and he might eliminate personal exemptions in total, which means that it doesn't matter how many kids you have. Right? The more kids you have, the more exemptions we have. That might go away in the future. So here's the current system we have. There's all the possible tax rates when certain filers will be brought into those tax rates. And you see here the very high 35 and 39% brackets. Now, notice the bottom two rates that many of my clients are in today. It doesn't take much for a married couple to reach the $413,000 and start paying 35%, and then only a few more dollars to be paying the 39.6% rate. At this time, this was a huge tax increase for anyone. The more money you made, the more money you paid. Trump is the total opposite, and we'll get to that. Business owners, though, what I saw in business owners and people buying properties was that this has an emotional impact. The more tax you pay, you eventually get to the point where you don't want to invest anymore. It's not worth it for you. So it gave more money to the government, had less money for investment and for business, and it was a loss of tax revenue to the government. And overall, it was a bad thing. That I've seen in my practice. So now we have Trump's tax plan, which we'll see, like everything, it's very simple, much easier to understand. And just note that the top bracket now is 33%, down from 39.6. So the more money you make, the more money you save, the more that you love this plan. Again, the maximum net tax rate would only be 33%. But this is good news for real estate agents, and why is that? The higher the income of a potential buyer, the less taxes they'll be paying going forward, so that money can be put towards larger debt and mortgages and larger houses, which is exactly what we want. So I was telling Linda, so this is an important thing to realize, that these rates might be retroactive to the first this year. So when they're going for mortgages, we have to make sure that the underwriters understand, especially when this starts to get passed, that we have to make sure we use some detailed analysis this year, because their ability to pay is going up. And I'm going to have some examples of that in a minute to show you what I'm talking about. Very, very significant. So the biggest losers in the plan, though, this is important, that it's not good for everyone. The lower income families, unless they have a lot of child care, would not see a decrease in tax at all, and would be possibly an increase. But that's under Trump's plan. I'm sure that as it stands right now, that's honestly what it is. So, and you have married couples, for example, if you have this bracket here now, 75,000, So you have people that are on the edge here. If you can have deductions, such as retirement planning, you can stay in that 25% bracket, which is a tax break for them. So there's a lot of planning that still goes on here that's very important. But you're going to see that there are people who are going to really have a loss, that they could have a tax loss, especially lower income people that don't have child care deduction. Because his plan is going to increase child and dependent care deductions very heavily, which is a good thing if you have them. And that's going to save people money. If you have $6,000 or $7,000 in child care deductions, no matter where your income is, it's going to be a great deduction now and save you a lot more money than you were. There's limits on child care no matter who you are. So it's going to really help if you do. And a lot of people have that, which is his thought. Does that make sense to everybody? All right, so
Any idea when that will be passed, or if it'll be passed?
I think it's going to be, anything that Trump does, going to be retroactive to January 1st this year.
Okay.
So all my planning, now that I'm doing planning, I actually have to have 2 columns of everything, old way and new way.
Just
So,
in case.
but it's just an important thing to understand, so you guys can intelligently talk about, that's why I'm doing this. I know it seems like a little boring, but understand what your clients are going through. They don't even know, and so it's important to understand where they could be and that they are going to be. And you'll have access to these slides, especially this next one's very important. So here he is, and again, let's take the personal feelings out of it, but I'm telling you that he equals larger home sales. There's no doubt. That's what he equals. That's all we want to know.
Okay.
All right. So here's some really good examples. If I take the old rates and if the basic Trump plan gets instituted, what does it mean? So here we see a married couple with 2 kids. They're earning $250,000. The old tax was $48,922. The new tax is $45,000, which is significant. A savings of $3,600 or about $300 a month. So that translates to you that I can afford more of a mortgage based on the low rates today. That's the important component to this. That if they had the same exact income from 2016 to 2017, they're going to have more money in terms of underwriting to get approved for bigger loans, which means we could sell them bigger houses, right? So the same thing. Married with 2 kids, look at the difference. I have almost $1,000 more a month. Same exact income, nothing else different, just a reduction in tax that, of course, is used for new higher more. Yes.
But you said that he's doing away with the dependents.
Right, and people in higher income don't get them anyway.
Okay,
They get eliminated.
okay.
So someone a couple earning $400,000 no longer has any personal exemptions.
Okay.
They're phased out because of income, which makes sense. It should be, but they don't get a break for that. Does that make sense?
Okay.
So lower income gets the break?
Lower income is not getting enough of a break that I can
Okay.
see at all. This is definitely, wealthy people are getting a very big break right now. That's 100% sure. That's how I read it. I've read it. I've gone over it many, many times.
And wealthy's considered a couple 250 and higher?
Well, to me, if you're earning as, like, for example, an individual who's single with no kids, I put this here, that's a negative. So a single person making $250,000 a year is paying more in tax. So you see, so married and single makes a big difference. So, but a single person now, the same person makes $500,000, he's now saving $458 a month. So he's in between that $250 and $500. It becomes a positive for a single person with no kids.
Is there an age cap on that where that is, makes a difference?
For who? For the taxpayer?
Yes.
No. You mean if there's an extra dependent for a senior? You mean like we have right now?
Yes.
No. He'll probably. I'm sure he's not going to eliminate that, but he might eliminate exemptions altogether, so it doesn't matter. So it's going to be across the board, no matter what age you are.
So
Here's
if you're
the rates.
80 or...
Right. You're right. Your income's your income. Your tax. Right. And it did give, what she was talking about is that of a certain age, you got an extra dependent exemption, or if you're legally blind or something, you got an extra exemption to ease your tax burden. And so if the exemptions go away, that's going to go away, right? So this is a very important to realize, because it should impact when people talk about their numbers for the past 2 years. There's more to think about now, and it could get you over the top, right? Someone having an extra $40,000 that we can get approved for a mortgage can make all the difference in the world. And then just even $20,000 and some, I know we do it all the time, right? So, very important that that's gonna be, talking to all my brokers I deal with, my mortgage brokers, it's very important, they have to consider this, they just can't do standard underwriting, take the past 2 years and average it, and see what your you can't do that, you know, if you're gonna really be servicing the client right. I get this question all the time, how long should we keep records? How long should we keep records? The answer is 7 years, all right? Why is it 7 years? Well, the IRS, if they go back to anything, banks aren't keeping anything past that far, they don't have to, so, and if the IRS is seeing someone hasn't filed in years, they'll go back 6 years, that's what they want. I've never heard about more than that, so I've never, unless there's criminal something, even then they can't do it because the banks don't have it. So 7 years, you're pretty safe, 6 plus 1. And remember, only keep documents that you're using as a deduction or for your business return. So I don't need your JCP&L bill if you're not taking it as a home office deduction. As long as it's paid, we can shred that right away. It's only things that I have need as support for a deduction. All right, does that make sense to everybody? All right. I want to talk about something that I have on the website that I posted with Linda. I have an ebook for exit tax. Everyone knows about exit tax? Or what it means for Jersey residents and non-residents? Right, some do, some don't. Now, exit tax is a very, very, very big issue, and it really relates to people that live outside the state that sell property in the state. That's what this is all about. But a lot of mistakes are made. Attorneys, I'm on the phone with attorneys every day arguing with them that you're not supposed to take exit tax in a blanket way, it's only in certain situations. So, the exit tax is actually a tax payment made in the name of a client. The idea is that you live in Florida, you're selling a property in New Jersey, there could be a gain on it. So, because you're not living in New Jersey anymore, Jersey can't come after you. So they want to withhold some money on that transaction in case there is a gain. So then you can file a tax return and then maybe get the money back or pay your tax with a non-resident, a short year return. So it's a credit. It's not lost. It's actually money as if you paid an estimated payment or had it withheld on your W-2. It's a credit in your name, all right? So, but it's unlike realty transfer fees. Not the same thing, and those are lost forever, and that goes into a crazy treasure chest somewhere. I don't know where it goes, but that's lost forever. We've seen it a million times on closing statements. So it's not the same thing. So what are the basic rules for exit tax? This is the basic rule. If you're a New Jersey non-resident and you sell real estate in New Jersey, then the attorney at the closing must make an estimated payment on your behalf of either 8.97% on the gain or 2% of the sale price, whichever is higher. So that's the blanket rule. Couples in Florida, they sell a house after 2 years in New Jersey. That's what attorneys think. And that's only the first rule. There's a lot of exceptions. So the first one is, if the federal sale of residence gain exclusion applies. Everyone knows if you have a house, you're a couple, you get to skirt the first $500,000 of gain. You know how that works? Everyone understand that? Can I explain it?
Explain it.
No, you can get it multiple times. So there's a lot of what used to happen with the sale of a house, the old rules, is that if I sold a house and I had a gain on it, I didn't have to pay tax on the gain, but when if I bought a new house, I could apply that gain to that house and reduce the basis. So eventually, my gain will be paid eventually, when eventually I sell the house and don't buy another one. But that was repealed and that's done. So what they started to do is say that if you have a residence, which is living in the house 2 out of 5 years as a residence, very important to know. So I can move to Florida and for 2 or 3 years live there as a resident, have been 2 years within the 5 in New Jersey, and I could finally sell that Jersey house. And then these rules apply, which means that if I'm a couple and I sell a house and it's my residence and I meet those rules, then the first $500,000 of gain is not taxable. It has nothing to do with any new house, any old house, nothing at all. So you could buy a house the next day, live in it 2 more years, that one 2 years out of 5, and the rules apply.
So New Jersey still thinks you're a resident?
Well, no. No, New Jersey, so in this case, let's say you are a Florida resident, 100%, and you sold property in New Jersey, so you have to look at these exit tax rules first. But because this federal gain exclusion applies, the main rule is that when you're thinking of exit tax, to say, if I don't have a federal gain, I don't have New Jersey exit tax for whatever reason. Like for example, I could be doing a 1031 exchange, right? I'm not going to have a gain. I have plenty of people who have Jersey real estate, live out of the state. I'm doing that all the time with 1031s because there's no gain and we have to prove it. And so it's very important because their attorneys will be conservative and take the higher of these two things, the 8.97%, and send it in because they don't care, and they want you to then, but I'm gonna withhold 2% on $1 million, and just, so I try to make that not happen. Well, I know what, yes,
I'm sorry. So you're saying if I live in Florida
yes,
and own property in New Jersey and I have residency in Florida, and then I sell the house in New Jersey.
yes.
But I have lived during that 5 years at any time in New Jersey?
Well, 2 of the past 5 years,
Right.
from prior to that date of sale, if I was a Jersey resident, then I can get the residence gain exclusion by federal
And
law.
not pay exit tax.
Right.
Okay.
Yeah, right. So if I can show for some reason there is no federal tax, that's just the logic to have with exit tax. It boils down to, so is there a way that there is no federal tax? So it isn't a blanket rule no matter what you take the money. No. There's no, because Jersey follows residence gain rules.
Does it have consecutive years?
No, not
That's
at
a
all.
good question.
2 of the past 5 years, for year 1, year 5. Could be an investment property in between. We do it, so very important that like I said, because the attorneys make the mistake of not sending in the money right. So I had $1 million, $20,000, we take it on the tax return, and Jersey says, well, you owe us $20,000. What are you talking about? You have a $20,000 credit. So you don't want attorneys sending in your estimated payments. Is also the
So really, you should call your accountant before the
No, here's my
closing.
Yeah, exactly. Exactly. So here's an example. Florida resident sells a former New Jersey resident. If there's a federal gain, the exit tax should not be taken. It's that simple. Florida resident sells a second home they had or a rental, exit tax should be taken. It's that simple. Because in those cases, it's not a residence. There's no gain exclusion, possibly, exit tax should be taken. It's that simple. And if you have a question, always call me.
But then you said you get it back?
Well, yeah, it's a credit. So let's say that they took $20,000 in my example, the attorney sent it in to Jersey Division of Taxation. Right, then on my tax return, my client's tax return, I'm gonna take it as an estimated payment. It's not lost, so but a lot of these times there's no exit tax, so people then are forced to do a Jersey return that year to have 0 income just to get the $20,000 back and pay me to do a return for no reason. So this circumvents that, all right? So, this is the Get Rep 3 form. So this is the form that you would use, that a client would fill out to tell the attorney for some reason, do not take the exit tax, they certify. Sometimes it comes along with a letter from me. My office sort of prepares analysis to give to the attorney and say, here, this is why it doesn't meet, it meets the exclusion or it's not taxable federally, do not take it, so they can have it in their file so they're off the hook. So, and this is simply, this thing in red shows you the real property being sold or transferred is used exclusively as my principal residence per the rules we just discussed, and you check that box and sign it, and the attorney has to accept that and not withhold the exit tax because you're certifying it. So this is a very important form, and again, people are going to ask you a question, because realtors should know about this, because people suddenly will ask you about it. At least you have a reference now on the website. This is all in my little ebook, just all for you guys. Say, well, how does it work, and look what rules apply, right?
I've never seen that before. I mean, this sounds like it's something pretty important for our clients, and it's never come up before. Does anybody else?
But I don't advise my people on financial things. I
No, I
refer them
would
to
say,
their.
go to your accountant.
Right, and they go to a closing, they have no idea.
Yeah, but
So,
that's the thing.
We have to tell them.
Should be
Right, so that's
before.
why I try to tell agents, oh, look, if you have someone that's not in New Jersey, no matter what their situation, investor, senior, okay, good. Say, by the way, make sure to check, is this subject to taxable gain? If not, don't let them withhold, because people go to a closing, they're not even looking at it. Right, this could be a $6,000 item, and it's a line item, they don't even know. I've had clients where they've had $25,000 withheld and sent in from 6 years ago that they never took a credit for, how to go get the money. And Jersey's sitting with it. They're not going to tell you.
Right.
So it's happening. Attorneys are doing it without you knowing it because they think they're supposed to, but they're not supposed to advise you. They're just, oh, this is the law. Take out exit tax on this line on the HUD 1, right? So, see it all the time. So that means then, just one last thing about this, that if someone is in Florida, and they do have an exit tax withheld, the way to get it back is they need to do a non-resident return for New Jersey that year. So they can take it as a credit, either against the gain or have no tax, at least get the money back. So that's the steps. If you do have someone that had it withheld, they have to really make sure they're ready to do a Jersey return, and make sure that the attorney gives you a copy of the letter that was sent to the Division of Taxation. And if they're not sure how to do it, they ask me, and I send them a nice little packet that attorneys can use to make sure things are filed right. All right. Make sense? All right, so home office deduction. This is a very important thing. Home office deduction is the biggest question I get. It does not trigger an audit. It does not trigger an audit. It's something happened in 1999 where the IRS was looking at home offices just randomly, and so everyone said don't do it. But it's a very good deduction, especially for real estate agents. It's a valid deduction if it's done correctly. It's well worth it. A lot of you are using exclusive parts of your house for your business, and so we should definitely be taking it. So what they instituted a few years ago to make it even simpler is a safe harbor method. So how you do a home office deduction traditionally is, okay, I had to take all my home expenses that I have, utilities and maintenance, all these other things, and then I take the square foot and all the percentage, and I'm going to apply that and take that little percentage as a deduction, right? So 10% of my heating bill, whatever it might be, and a bunch of other things. And so that can be cumbersome. So they allow you to do up to $1,500 per year as a flat deduction with the safe harbor method. It's very easy to do, and I think I even going to upload that on this folder that's linked with Linda. But definitely take the home office deduction if you have a home office, because this not only saves you on your ordinary income tax, but as self-employed people, it saves you on the FICA, the self-employment tax, which is very important, right? So we're going to talk about estimated taxes too.
If you're renting, can you take out a portion?
Definitely, yep.
Mhm.
It's still, your expense is your expense. Like, so when you're home, for example, you could have mortgages and taxes, and even though you can take them as an itemized deduction, I want part of that to be taken as home office, right? Because I'm getting the FICA savings. I'm still getting the ordinary income tax savings. That's why even if you own or rent, you want to do the schedule, and you want to take it because you want to save that 15.3% self-employment tax on every dollar we can.
Chris, Kathy, Heather.
Yes.
I'm sorry, so you advocate an itemized deduction for this? Because our accountant, a couple years ago, had said, you know, just do like I shouldn't itemize as part of the larger picture, but I think.
Well, don't forget that this is not an itemized deduction. This goes on your
Oh.
Schedule C.
So when you say to take that,
Well, right, so let's.
what kind of deduction is that?
Well, let's separate. So first of all, we have Schedule A, which is itemized deductions. You can have them whether you have a business or not, right? So it's contributions and mortgage interest and taxes, you know, things like that, charity. But if you have a business, you guys are 1099, you're gonna have a Schedule C, profit or loss from a business. So, and that's also on that folder. You'll see a nice fresh Schedule C. So you want to take as much on the Schedule C as you can as deductions, because it's gonna reduce your ordinary tax, but also your self-employment tax. Do you understand how self-employment tax works?
But that's not considered an
No,
itemized?
no.
Okay,
No, itemized deductions have nothing to do with business. I know it's confusing.
Okay,
And it's-
okay.
right, and so you want, right, it's a business deduction. That's why I call them business deductions. So home office goes on your Schedule C as another deduction with your
Okay.
telephone and your travel and everything else. So we do it home office schedule. So, and it all depends if you want to take the safe harbor. Sometimes people have more than that. There are people with some substantial home office deductions that it's worth it. And I have some worksheets I put online for you to see that. Hey, here's what I would normally total up, and it makes it easier for you to say, add up all of this, and then we easily can know. So if you do a little homework, it's worth it, because what if you really have a $2,300 home office deduction? That $800 could mean $400 to you, depending on your tax bracket. So it's worth to do a little homework. If you got the worksheets I give, it makes it easy for you guys to do it, then I can take a look at it.
But you're saying if you use just the safe harbor, if they see you're a realtor and you put 1,500 that's not like triggering like, hey, oh, like let's check this out. It's like pretty standard. Like most realtors are just gonna put 1,500. I know. I still don't believe it. I don't know
It
why.
has to be broken down.
He's gonna do it again, he's gonna
Right?
keep pushing it till you believe it.
Well, anyway, the important thing is that if you have a valid deduction and we have support for the deduction, we should take it. So if they ask the question, we answer it. Remember, people have the wrong impression of the IRS. Everyone, first of all, thinks of them as a money collector, right? But that's not really true. They have a collection mafia type arm, the Tony Soprano wing over here. But they're really compliance geeky people, even agents. They're compliance. So for example, that's why late filing of the return has more of a penalty than late payment. They want that return with your name on it, checked, okay, April 15th at 10:40, I don't care if it's $1 or 200 million. That's the first thing. So they're form-based, compliance-based. So first of all, what triggers an audit? So if we do the numbers the right way, a big part of the problem with other accounts is they don't have enough categories of things. So they have a lot of realtors in their database, right? So some make $5, some make 5 million. But you have to do some ratio analysis as to are things reasonable, right? So is your telephone expense the same kind of ratio against sales? It's part of what we do. We do a lot of IRS work. So that's really the question. And again, to finish about the IRS, they're not a sharpshooter. They're not CSI. I wish they were. 95% of notices I get are wrong. 95%. I'm not lying. I wish I were. Worst part of my job, I can call customer service at Target to exchange a shirt faster than giving them information. There are things I need to do and get paid for I should not have to. It's a real disservice to everybody. So randomly they could audit you or something, but I would never let a number go out the door without discussing it with you first. Like that's what accountants don't do. Like the H&R Block thing is, oh, we're going to sit and get this done in 5 minutes and good luck and next. And that's a problem. This is the biggest financial transaction you do every year. It should be treated that way, you know, and with someone that's as anal as me about making sure it's right. So we have this. The basic rules are it needs to be exclusive area. That's supposed to be an exclusive area that you're using in the house for work. Not that you're going to have to submit that with your return or a picture, but that's the rule. And
Does it have to have a separate entrance? No,
No,
just
no,
an
not at all, no.
exclusive area.
Exclusive area.
Office.
A part of a
The
room
door,
could
yeah.
be, right. And
A
so,
bed
okay.
doesn't count.
what'd you say?
A bed in the room.
Doesn't matter.
Working off the bed. All my paper, guest room slash office.
This is that special real estate agency I heard about. Finally found it. Okay, so deduction. Let's talk about deductions for a minute. Any disbursement made that relates to your business can be deducted. So if it relates to your business, the answer is yes, and you should let me see that and total it by category. And it might seem very common, but people ask me, well, can I take it as a deduction? Well, and I said, well, as it relates to your, and everyone has different expenses for different things. If it relates to your business, we're definitely going to take it. You need to make sure we categorize it correctly. Like, for example, there is never a miscellaneous deduction. I never have a miscellaneous deduction.